Alright guys, in the week ahead we will of course need to still be on the lookout for any significant Brexit developments as we are still in crunch time. Apart from that, we'll also have events like the RBA meeting as well as NFP coming up for the US on Friday. We also have ISM manufacturing and services PMIs to look forward to as well. But the other upcoming event that we will be very interested in to keep track of is the upcoming OPEC and OPEC plus meetings and how that could potentially impact oil prices and by extension the oil sensitive currencies like the CAD, the NOK and the ruble. Now oil prices saw quite the rip to the upside after OPEC announced their three-phase production cuts earlier in the year, and after reaching key resistance at 43.50 in WTI at least, we've been moving rather more range bound. Now more recently, despite the blips that we had lower both in September as well as in October, we've seen a healthy push to the upside for oil prices, and that has basically come about from a couple of factors. Firstly, we have of course the broad-based dollar depreciation that we've seen recently, which is the dollar in the blue. Secondly, we've seen a steady reduction in oil volatility, which is this one OVX here on the chart in purple or pink. Looking at OVX here on the chart, we are currently still at elevated levels at 46, but relatively calm and stable from what we had earlier in the year. And what is very encouraging for the most recent move to the upside that we've seen is we haven't really seen any meaningful upside in volatility. Volatility has stayed rather calm. Apart from that, of course, the biggest driver of the recent push to the upside has been the overall optimism with the vaccine optimism from news from Pfizer, Moderna and AstraZeneca. Now, the good news has also seen quite an interesting development occurring in the oil market, which is known as backwardation. Now, for the biggest part of the year, the oil futures curve, this is the curve for WTI by the way, looked very similar to this one that we've seen in October, which was basically in contango for the biggest part of the year, which means that the expected price of future contracts further out was basically higher than the more recent contracts or spot. But with the vaccine optimism, what we've actually seen backwardation expectations, which means that the price of the near-term futures contracts are higher than that of some of the later ones. Now, backwardation is quite a bullish signal in this specific instance because it reflects the market's, let's say, positive re-evaluation of what vaccines might mean for the current supply and demand imbalance that we have in the oil market. And what's even more positive is that the backwardation is only seen from 5 months out from now, while the first 5 months are still in contango. And that's healthy in my opinion, because it shows that the markets are not, holding on to unicorns and rainbows by thinking that a vaccine will just instantly solve all the demand issues for oil. But the fact that contango is still in place for the first 5 months shows that meaningful improvement in that overall demand issues that we have right now is only expected to occur from about the end of Q2 2021. So for those that are up to date with the videos inside the terminal or trade ideas that we have in the terminal, you would have been able to quote a great run higher in WTI. Sadly, as you guys know, we booked the majority of our gain on that position at about the 43.50 price level. But the bias still remains higher given the expectations going into 2021. So for the week ahead, what's the focus then? Well, it's Monday and Tuesday's OPEC and OPEC plus meetings. Now, when OPEC made that decision earlier in the year to cut production, they basically did it in a three-phase plan. Now, what those three phases were is that the first one saw that big production cut of about 9.7 million barrels, and that ran from May to July. The second one, where we are in now, is 7.7 million barrels per day, and that's running from July until the end of December. And then we have that third one, which is expected to come online, or was expected to come online from Jan 2021 and run until April 2022. Now, what has happened recently though is we've had that massive spike once again in the virus throughout Europe, throughout the US, those renewed lockdown restrictions, and with all of that volatility we had in the market, we also saw WTI prices, remember in October, drop over $10 per barrel. So all of that saw the markets basically starting to price in the anticipation that OPEC won't move to that third phase in January, that they'll look to basically delay starting with that 5.7 million reduction and not started in Jan, but rather started in either, let's say, April or maybe later as in July 2021. Now, even though the initial suggestion was for that delay of about 3 to 6 months, the recent optimism that we've seen in the vaccine news and that big push that we had in the upside in prices has started to spark some concerns from market participants that some of the OPEC members in the cartel might not be open to do that big delay of 3 to 6 months anymore, because prices are looking a little bit better. Now, there is some caveats to that, and why some banks like UBS, ING, and Goldman Sachs still expect a delay in tapering is the fact that we've had that massive surge in the virus, as well as the new renewed lockdown restrictions. And even though we have the vaccines that's going to be set to come in online, the expectations of demand to recover is not expected to occur instantaneously. Of course, it's expected to occur over the next couple of months as more and more people start to get vaccinated. So the recent surge in the virus, as well as the lockdown restrictions, should still give the cartel reason to delay those tapering. And apart from that, we've had that massive surge in Libyan oil production, with their output increasing by over 1 million barrels per day. So all of that should still see them follow through with either a 3-month or possibly higher extension in terms of those tapering. The problem with that is that a 3-month extension has arguably already been priced into the market by now. So if we just get a 3-month extension, that's probably not going to do a lot for oil prices in the short term, and it could actually see some additional profit taking and can see some downside pressure coming into oil prices. It also means that if they do come out with no delays, as some of the guys are fearing right now, that could see a nasty knee-jerk reaction lower in oil prices. Whereas the most bullish outcome will, of course, be if they come out with a 6-month or even more delay to that third stage of production cuts. Now, the most important thing to take away from this week's meeting is what it means for oil prices going forward. Now, oil traders were happy to buy oil with forward-looking expectations for oil demand eventually picking up in 2021, which means that one OPEC meeting shouldn't be enough to really change that overall trajectory going into 2021. Now, with vaccines expected to roll out in the millions in the first quarter and second quarter of 2021, the markets are expecting a strong rebound in overall global demand and the overall global economy. And as vaccines roll out, there is some expectations that we might see some pent-up revenge travel coming into the market, and that can create some additional upside for oil demand as well. So even though OPEC this week will be important, it can of course create some short-term up and downside opportunities. We would consider any significant dips in oil prices still as buying opportunities, as the road to eventual economic recovery is priced in by the markets. So looking at some trading scenarios, scenario 1 would be no delay in tapering. Like we said, that's not the base case right now. That would be the most bearish scenario for oil prices in the week ahead, as markets are expecting at least a 3-month delay in tapering. So if we don't get that, of course, the most bearish reaction in that scenario, we would expect to see downside pressure in WTI and Brent crude. Also expecting to see downside pressure in oil sensitive currencies like the CAD, the NOK, and the ruble. Do keep in mind we have a couple of important data points coming up for the CAD as well. We've got GDP coming up and of course the jobs report. So keep that in mind as you go throughout the week. And thirdly, in that scenario, we would also expect some possible weakness in the more energy heavy equity indices like your FTSE 100. Now, like we said earlier, given the market's overall expectations of mass scale vaccine distribution during quarter 1 and quarter 2, we would use any significant drop in the price from such a scenario as an opportunity to simply buy back or buy the dip with an aim at a more medium or a longer term bullish bias for oil prices. Scenario 2, 6-month or more delay in tapering. Now, again, this is not the base case. Especially right now, the base case is for that 3-month delay. So if we do see a 6-month delay or even more, that's going to be the most bullish scenario for oil prices. And if we do see that, we would expect to see upside in WTI and Brent crude, upside in the oil sensitive currencies like the CAD, like the NOK, like the ruble. Again, keep in mind those individual announcements coming out for the CAD this week. And then number 3, possible strength in the energy heavy equity indices like the FTSE 100. Scenario 3 is just as expected, we get a 3-month delay in tapering. Now that's either going to see a very muted price reaction, nothing really happening at all, or it can lead to some, like we said, additional profit taking, and that can lead to a type of buy the rumor, sell the fact reaction in oil that can see a possible short-term knee-jerk reaction up and then a massive sell-off occurring. Now, if that happens, once again, we would expect either a possible muted reaction in oil prices, in oil sensitive currencies, and that energy heavy equity indices like the FTSE, or we would see downside or expect downside in the majority of them if we do see that buy the rumor, sell the fact sell-off taking place. But again, like we mentioned in that first scenario, given that more broader view of upside potential for oil prices, if we do see any significant short or medium term dips, we would definitely still consider that as an opportunity to get back long on oil with that more medium and longer term bullish bias still in place.